Stocks in the railway engineering space have made a swift recovery from their lows back in March. Unlike the widespread apprehensions about the impact of COVID-19, these are reasonably insulated businesses. In our Ideas for Profit today, I'll discuss whether IRCON International is a compelling bet for investors for the long-term portfolios of theirs. Let's look at the Q4 earnings first. Now, close to 95% of its order book actually comes from the railway space, and also the rest of the order book actually comes from the construction of roads. Now, typically, revenue recognition happens to be higher in the fourth quarter of the engineering company, particularly in the case of, say, government-linked projects because of the billing cycle. Now, this is precisely the reason that despite the COVID-19 impact, IRCON did not face much problem and has posted a good 17% year-on-year growth in the revenue in Q4. Now, international revenue fell by over 37% on a year-on-year basis, but since it merely accounts for about 6% of the total revenue, it did not have much impact. Now, the core domestic revenue grew by a good 24% on a year-on-year basis. Despite the higher revenue, the company also faced pressure on the margins this time around. EBITDA margins dropped by 303 basis points to 7.24%, led by lower execution and conservative approach in the revenue recognition. Now, the other income too shrank by 42.6% year-on-year. Now, by the end of March 2020, the company reduced its debt to 1846 crores as against 2560 crores back in Q4 FY19. Now, the gross debt to equity stands below 0.5 times. The Q4 net profit reported a strong 28% year-on-year growth thanks to the lower taxes. Now, the company has taken the requisite measures such as allowing employees to work from home, to curb the inefficiencies and improve productivity. It is also taking advantage of the digital platform to restore the supply chain and improve execution as far as possible. While these steps are definitely expected to lower the impact of the pandemic, but the productivity would still be lower at least in the first half of the current fiscal year. Now, we expect the recovery to start only by the second half, helping the company to restart some of the stalled projects or projects where execution had really suffered. Now, effectively, the net impact on revenue could be marginal. We expect revenue to decline by 10% this year and increase by 25% in the next financial year, led by strong recovery and the order book. Now, the company's order inflows and order book has been good. Notably, the international markets have also seen good traction. It has recently bagged large orders from even Sri Lanka and Africa. Now, in domestic market, IRCON has been a big beneficiary of the railway capex, which will only increase in the years to come, given the pipeline of the railway projects such as bullet trains and all the other trains as well. Now, in order book, which was around 18,900 crores in FY16, it has jumped to over 30,000 crores by March 2020. And the order book is 6 times the annual revenue, providing the highest revenue visibility right now. So while the stock has recovered from the lows, it is currently trading at 86 rupees per share, still offers good value, trades at 9 times FY22 estimated earnings, and offers a good dividend yield of close to 6% as well. Now, considering the strong order book, the robust cash on the books, the government support, the story still remains quite compelling. So investors can actually go ahead and accumulate on dips going forward.